Good morning. It's Richard Calhoun, real estate broker with Creekside Realty, 40 years experience here in Silicon Valley working with consumers. We're here today to discuss the real estate market, mostly in the last week. We'll look a little bit at March month to date. Here are some URLs that are useful for you to know. The green is what I call the root URL. That's what you need to get to everything. You add the year 2021 to get to this meeting. You add the word handout, the year, the 2-digit month code and the 2-digit date code to get to a handout. It is not yet out this morning, but it will be out shortly after the meeting's over with. Moving down the page, you get to the root URL itself, gets to the YouTube archive, and to get to any specific section, you put in the year, the month, and the day code, and we started in basically April 1st timeframe of 2020, right after COVID. And at the bottom of the page is my contact information. This is looking at the days of unsold inventory. Days of unsold inventory is what I consider to be the key indicator of the future health of the real estate market. It's how quickly would everything on the market sell at the current rate of sales. You can, each of these 22 different micro market areas you can see is pretty close together. They basically range from somewhere around 10 days, which means we could sell everything out in just a week and a half, up to a high here of about 55 days. That is pretty phenomenal. Normal marketplace is 40 to 80 for most of the micro market areas. Some of the micro market areas have a normal range of 75 to 150. So all our areas are experiencing a strong marketplace right now. Each one of these is a different geographical area or type of property. You can see the key at the top. Now what we're doing is we're looking at just what's happened in the past week. We're putting everything together in a blender in San Mateo County and Santa Clara County, single family homes, condos, and attached homes. We have two different lines on here. We have the gold line, which is the 5-year median, 2015 through 2019, which were 5 good years. So if you're on the yellow line, you're having a good year. This is current inventory, what's available for the buyers to buy. And you can see that about 4 weeks ago, the blue line dipped below the yellow line, so we actually had less inventory than we normally do. And this is what everybody's making a big deal about, is we have all this lack of inventory. I'm going to actually show you that the bigger issue is that we have a surplus of demand. We have a huge amount of demand compared to what we've had in recent years. Because you can see up until just about 4 weeks ago, you basically had normal inventory, not a shortage of inventory. This is looking at the different areas broken down a little bit for you. I'm looking at days of unsold inventory. There's a lot of data on this slide. This is sort of where I go to make sure my numbers make sense. There's an awful lot of processing that goes into coming up with these graphs. So you go back to very simple math. Does it make any sense? So the top line is active inventory, and the top line is a week ago. The bottom line that's bolded is this week. So you can see inventory has gone up from 1658 to 1811. Then you can look at each one of your counties and type of property. So you have the type up here, single family homes, condo, townhouses, your two counties, San Mateo County, Santa Clara County. So basically, when you look at this, every area had an increased level of inventory from last week to this week, which is what you would expect to happen as we go into spring. This inventory typically is going to grow until about the middle of July. Offers tend to grow until Memorial Day and then start tapering off a little bit. This is the number of offers accepted. Got two different lines here. The top line is what happened in just the last week. The bottom line is what happened in the last 5 weeks. So if you take 530, multiply it by 5, you're at 2650. So basically the level of inventory sales activity for the last week has been consistent with what it's been for the last 5 weeks, which is a little unusual because normally inventory increases as the summer goes on. But if you go back 5 weeks, I think we include President's Day holiday, which tends to negatively impact sales. And again, you have the breakdown by the type of property, single family or condo townhouse, as well as the counties. And then you come down to what to me is the keys, days of unsold inventory. So basically, if you look at everything in the blender, you have basically 24 days, 3.5 weeks of inventory. If you look at single family homes, it drops to 21 days, and there's a split between counties. San Mateo County is sitting here at 25, 26 days. Santa Clara County is sitting at 19, 20 days. Go over to condo townhouses, they're a little bit slower. They're at 30 days for both counties, 36 for San Mateo County, and 27 for Santa Clara County. It's also noteworthy that normally Santa Clara County is the slower of the market, San Mateo being the faster. We have the reverse situation going on right now. Basically, what it says with COVID, people are willing to commute a little bit and they want a little bit more space, so they leave San Mateo County and come down into Santa Clara County. Now we're going to look at the different components. There's 3 lines, but only 2 components because we have 2 measures of inventory. One is the total available inventory and one is the new listings. So that's your supply side. And on the offer side, the demand side is the number of new offers. So again, the concept's the same. If you were having a normal year compared to the last 5 years, you'd be right on the yellow line, the gold line. That's because I'm comparing it to that 5-year standard. So if you're at 100% of the 5-year median, then you're having a normal year, and based because the 5 years selected, 2015 through 19, were great years, you're actually having a great year. So what do we have going on? Well, you can see inventory is just now a tad below where you'd expect it to be. But yeah, I mean, I don't know what that number is. I would guess about 97.5%. If anyone's making a big deal of being 2.5% short of listings, they're missing the boat. And we'll see that because, right off the bat here, the number of new listings this last week is 20% more than you'd expect it to be. But here's the real story. Look at the number of offers. They're at 20% above what you'd expect them to be. And they were as much as 40% above what you'd expect them to be. So the storyline should be there's too many buyers trying to buy the homes that are available. We essentially have normal inventory. We have a surplus of demand. We have a surplus of buyers. That's what's driving the marketplace, not the lack of inventory. Here you can see, again, this is total available inventory. My total available inventory does not include contingent pending to show transactions that most people include. And the reason I don't include them, they're not really available for the consumer to buy. And you get misleading information right at the beginning part of the year when you have no inventory and you have a lot new of transactions starting. The pending transactions go way up, which causes the inventory to increase when the number that's available for a buyer to walk in and buy today is actually decreasing. So I think this is more accurate information. You can see that we're just a tad below the yellow line, which is what we were saying before. I was saying it is about 97.5%. Here is the same concept. This is the number of new listings. You can see the number of new listings is way above where you'd expect it to be. You're up here at 650 new listings. You're only expecting 525. We're getting 20% more listings than you would expect. It's getting eaten up by the 25-30% extra demand. And here we are with the extra demand. I don't know what the numbers are, maybe 475 for normal, and we're sitting here at something like maybe 560. You're having almost 100 extra transactions on less than 500. That's more than a 20% surplus in demand. We are not going to fall off this Rock Canyon, Grand Canyon that we did last year. I'd expect it to basically follow around. Now, it is interesting that there's this little dip in the number of offers, which sort of goes against what I was saying earlier, that you'd expect the number of offers to go up through Memorial Day. This is just a little statistical fluctuation. If we looked at it, it probably has to do with holidays. We're coming up on Easter, so this could be the Easter dip and things like that. When the holiday like Easter moves around, you're going to get a more of a bowl-shaped dip, where if you have a set holiday, you're going to get more of a spike like this. And the data does spike more from week to week than I would expect when you're only looking at 1 week data, but it's because it's unstable because you're only looking at 1 week. Now we look at closings. There's really nothing much different on closings than there is in offers, because basically most of your offers that go into the escrow close, especially in a strong marketplace. Because even if the buyer gets irritated or finds a problem, they're looking at, do they walk away from this transaction that they're in and go back out and face multiple offers and maybe not get the next house. And so they put up with more. So nearly all of your transactions that start close in a strong marketplace. Yeah, 5% fall apart. But the big shift here is about a 30-day lag time for the duration of your escrow to close. And you can see that the closings are above normal. Now what we're looking at is frequency of overbidding. This is how often are sellers getting more than their asking price. And this requires the sale price, so it requires a close of escrow, so you have a delay. That's why the slope down last year didn't happen right at shelter in place, but happened over time. Do I expect it to dip down? No, I'd expect it to go up. It's a little interesting that we came down from last week. Last week we were up here at about 73%. This week we're down to like 69%. The week before we were almost at 75%. The fact that it's coming down is a little bit surprising. Maybe buyers are getting wary of overbidding. Maybe buyers are saying if we wait a couple more months, the market will not be as hectic. But the frequency of overbidding for the last 2 weeks is down. And I think that would surprise a lot of people, even though the market still remains strong. Here's the magnitude of overbidding. You can see again that follows the pattern of frequency. And keep in mind, this is not what happened just last 2 weeks. This is what happened 30 days plus 2 weeks ago, because you need that sale price. And again, you can see 2 weeks ago, your sale price was the peak magnitude of overbidding at just over 107%, then just under 107%, and now we're down to 106. So don't get me wrong, the market is still strong, but for whatever reason, transactions that were initiated 30 days ago were able to not go as high and were as successful. Here is the different micro overbidding in the different micro market areas. Basically, just a word of warning, there's a little bit more movement from basically the end of January until the beginning of March. A lot of this is data issues that I'm still clearing up, like this one comes down and goes back up, this one comes down and goes back up, but most of them go up. I think the trend is generally up. I now have most of my data acquisition and processing issues corrected. So I will try to go back and correct some of these. Some of these I probably won't be able to correct. So just remember there was issues and we worked on getting them solved. And I think we're going to have a smoother road going forward. This also is interesting because this shows just the macro data. It shows the overbidding distribution. The red line is the current line. This is as of midnight last night. It's dated the 20th because that's when I processed the data. It's actually down from last week. The last week was this orange line on the 13th, and I was pretty optimistic and strong on, how far out it had jumped from just, the week before, but now we retracted a little bit. So this is your best month ever, which was April 2018. This is the worst month. And then these are the recent weeks going back to the beginning of November. So the dotted lines right through here are the oldest data, then the dashed lines, and then the solid lines. So the solid lines being at the top of the pack indicate that the strongest marketplace. But last week, the closings that occurred last week were stronger than the closings that happened this week. Could be data fluctuation, could be changes in the marketplace, could be if we went back roughly 4 or 5 weeks ago, we would have had a holiday. Those are the kinds of data fluctuations that impact the data when you start looking at just 1 week worth of data. Here's the same concept with just less data points so you can see it a little clearer. The dotted lines are the oldest, followed by the dashed lines, and then the solid lines. So if you went through, you probably would see that we went down and then turned around and came back up like that. You were going down towards the end of the year with the holidays, and then after you get past New Year's, and remember there's a 30-day lag time, so you have to get back to about like January 23rd till start getting the 2021 closings, then the market would have progressed forward. Here is looking at this week's data, and that's not this week's data, it's, as the graph says, March 2021 data. How can I be saying that? Well, normally I go from March 1st for 35 days. When I'm looking at this and we're still in the month, I'm going from March 1st to present day. So this is March 1st through March 19th, plotting it compared to all the different Marches. So you can see that we're not having a record year, which a lot of people think we are. We're having a record year in the franticness, the speed of the marketplace, not the overbidding. And I believe the reason for that is anytime the market has an insult to it, whatever the cause, buyers get cautious and don't overbid so dramatically. The amount of their overbidding is what pushes the line up here towards the all-time record in 2018. So they can be overbidding frequently, and that's where the line leaves the x-axis. The further the line goes to the right, the more frequent overbidding is. The magnitude pushes it this way. So as you get a stronger marketplace, you go 45 degrees up and to the right. Same concept, the dotted lines are the oldest, followed by the dash, and then the solid lines are the more recent years. So you can see for the most part, the most recent years years are the strongest. Yes, you have an old dotted line here, which is probably 1999, and you have a dashed line here, probably 2013 would be my guess. But you can see that we're having a strong year, and the amount that people are overbidding, both the frequency and the magnitude. Not a record, but strong. What the record is the speed of the marketplace. And with that, I'll pause to see if there's any questions from anybody. Not hearing anyone here. This is where I wanted to be. What we'll be looking at now is 11 different metrics in 5 different graphs. We will be mostly looking at the county data. Some of the data will be looking at the individual micro market areas. So this is days of unsold inventory. As I said, that's our leading indicator. Again, we're going to have some roughness in the data from the end of January to the beginning of March. So these 2 spikes, I'm not sure how real those 2 spikes were. I do have confidence basically since the beginning of March forward, and you can see the DUI is pretty slow in the 3 counties, red being Santa Clara County, it's the biggest, gray being San Mateo County, and then the yellow being condos and townhouses in Santa Clara County. So these are what I'd expect to be between 40 and 80. And in that range, 40 to 80, you'd still expect appreciation. Down in this 20, 30 range, you expect rapid appreciation, and that's what we've actually seen this year. This is looking at the magnitude of overbidding. I will point out this drop in San Mateo County is pretty amazing. I think it's going to turn out to be a statistical fluctuation, but see in Santa Clara County, this rollover, I think that rollover is actually probably real. This is about when the market starts to peak. The 5 weeks before Memorial Day is when the most offers come in, and after that, the market starts slowing down. So basically, the month of May. So we're not that far away. If April is the busiest time of the ramp up, the fact that this is going from this huge step up that I basically think happens at the first of the year, it takes a while for the data to show up. It takes a while for the consumers to realize the market's going. There's a hysteresis. So we're already leveling off, and the buyers will feel this in another 4 weeks down the road. This is the median days on the market, which isn't very telling overall. That's because the listing agent can control how many days by relisting the property and that kind of stuff. But you can see Santa Clara County is the fastest with 8 days. You can see that that is really the record quickest speed. This dip here was because during the shelter in place, the MLS froze the days on market and wasn't counting it. So when you were at 0, we were selling half the homes that came on the market. Half the homes that we're selling came on and sold all while shelter in place was occurring. You can see Santa Mateo County is a little slower, 1 day slower at 9 days. It bounces up to 10. That means it's right on the verge, and condos and townhouses are slower, bouncing between 11 and 12. Now you're looking at the current available inventory in the different micro market areas, and you can see that they're low. But you can come back here before the pandemic, and they're basically equally as low. Here are your county datas. Yes, if you look at Santa Clara County, we're now at 600 homes on the marketplace. You come back here and it's a little unfair. Well, so let's come back to just before shelter in place. So you come back here, you're at 650, actually call that 700, and now you're probably at 630. So you're down 10%, and that's just rough numbers. I think that should be pretty accurate. The big difference is that 25% increase in the demand. And if you look at condos, are right now at somewhere around 500. You come back to shelter in place and they were down around 250. So the condos are basically double the inventory. And if you look in San Mateo County, they were sitting here at about 350, 325 maybe. And you come back to shelter in place and they were maybe at 350, maybe even the same level. So Santa Clara County single family homes, the most in-demand area, has a little bit less inventory, but San Mateo County has essentially the same inventory. Condos have more inventory. So the concept of lack of inventory, again, that I'm hearing in the media is just not accurate, in my opinion, for Santa Clara County and San Mateo County. It's the huge amount of demand. There's a huge surplus in demand. And here we are. Here's our demand. Look at this. You have 1,250 homes in the last period of time. And you go back, even if you go back to the pre-shelter in place to the peak at 1,000, I mean, this is going several weeks before shelter in place and shouldn't be impacted. So it's the demand. There's no question. And look at the condos. You're sitting here at 600 now, and before shelter in place, your peak was 400. And if I do San Mateo County, they're now at 425, let's call it, and maybe they were at 380, 390 before shelter in place. So all three of the major components have more demand than they did before shelter in place. This is a demand driven rush to the marketplace, rush to on the marketplace. Closings really are no different than the demand. They're just lagging behind. Now we're looking at sale price. This is the 10 percentile price. It's what the lowest end. So you can still buy a single family home for just under $1 million in Santa Clara County. Now they may be 2 bedroom, 1 bath. They may not be in desirable area, but that's where the cheapest 10% is. The more expensive areas up here in San Mateo County, Menlo Park, you have to spend it looks like 2.75 million to buy the cheapest homes in that area. Now, 10% isn't the cheapest home, but it's the cheapest home that will come available at any degree of reliability. And so you can pick out what your price range is and find the floor. And this is well, their condos and townhouses are in here as well. The CT, these would be condos. I can't find them quickly on the slide. Here is the major micro market areas and condos and townhouses I was just talking about. You can still buy a condo in Santa Clara County for about 550,000. Again, it's the bottom of the price market. So there may be a small condo, it may be in a rundown complex, it may be in a non-desirable area, but you can still buy for $500,000. Now, if you go up to single family homes, that number jumps up to about 900,000. And if you go into San Mateo County, that number jumps up to about 1125, something like that. This is the median price. This is what most people follow. Most people only follow by the county, but this gives you an idea of which area. And this red area, I think, is probably going to be the what I call the base cities in San Mateo County. And that was where I was actually collecting the raw data. So this data down here is duplicating another area. I think it was duplicating the North San Mateo coast. So I was collecting the North San Mateo County data twice instead of the Bay County. But you can go from here to the peaks to here and be accurate. And that is now corrected. And I think that explains why we had these big drop downs in San Mateo County median prices. I was bringing in a low end, the northern San Mateo County. So the way you would really need to go is from here up to here to here to here. And I will be going back and at least deleting this data and probably using the data from before and after to fill in to get a little closer to where it should be. So basically, this line has to be smoothed out a little bit. Now we're looking at the high end. Again, this is the top 10%. This is the most expensive. So you can actually go and easily spend $8 million in a house in San Mateo County, most likely in the San Mateo area, which would be Hillsborough, Menlo Park, Atherton, Portola Valley. Those areas are the most expensive areas in San Mateo County. Here's the county marks. So in condos and townhouse, the top end is about 1.5 million in Santa Clara County. Santa Clara County single family, the top end is about 3.2 million, and in San Mateo County, it's about 3.8 million. So the reason you want to cover the top end of the marketplace and the bottom end of the marketplace is the median doesn't really give you any idea what's happening on the extremes. Now you have what's happening in the middle plus what's happening on each end of the sandwich, and you can get a better sense of what's going on. Duration of closed escrow, that slide's going to be coming out because it's pretty useless. We're taking about 30 days. And with that, I've finished up. And if anyone wanted to look at the historical monthly data, that would have been last week, and I will refer them to that. Now what I will do is pause and ask for any questions, and then I'll post the handout and see people next week. Anyone have a question for me? Okay, enjoy the week. See you next week. Take care, everybody. Bye now.